Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. So we've been writing to clients for quite some time now that we knew there would be hiccups as we headed into 2023. In our recent white paper from last week, there were shocks in 2022. We call them aftershocks in 2023. We didn't know exactly where they would lie, but certainly if you look at the mark-to-market risk, and we have been around interest rates and mark-to-market for the better part of 25, 30 years, we knew there would be issues. And we began to see those issues, obviously coming out of the UK, and we saw what the Bank of England did. And certainly now here, Mohamed Al-Arian, who I follow pretty closely, I think he said it best. He said, this is a banking tremor, not a banking crisis. So, but still, there's more that remains to be seen. But short term, I think certainly if you look at sentiment in the marketplace, which is still tentative, there are risk factors out there. If you look at the Fed's balance sheet, if you look at the lending programs, things have certainly subsided short term. If you look at the G-SIB earnings to date last week, obviously coming out very, very strong for Q1. We're seeing some issuance in the marketplace today, which is great. It's a great sign. But the evolution of the banking sector over the last 15 years, really since the global financial crisis, is still occurring, with the focus now, certainly on some of the smaller players in the banking sector. And I think the issues around that, some are known, some are unknown. There's a lot of good information out there in terms of how those dynamics play out. From a market perspective, if you go back to last week, you look at, we follow Fed Governor Waller very closely. We think he is one of the more thoughtful and influential Fed governors on the board right now. Certainly hawkish comments. The Fed is intimating, and it sort of fits our view that we think the Fed wants to push a little bit higher here. When Chair Powell was asked recently through communication and writing from Congress about further rate increases, where things are at, he pointed to the dot plot. So 5.1, one more rate increase. We do think the Fed will be inclined to pause and take a break there. But we also feel too that had this little crunch that we're seeing right now, and we still don't know exactly how that's going to play out. And that's part of the issue here too. I don't think the Fed knows exactly how it's going to play out. We all, we have opinions, we have thoughts. There is intuition involved in terms of what this likely looks like a quarter or 2 quarters from now, but the Fed is not really clear. That dot plot number probably would have been higher, in the range of 5.5, maybe even higher than that. So the Fed is certainly counting on some sort of credit contraction as the year goes forward. They're counting on that credit contraction, I think, in terms of equating to a number of rate increases. But we don't know how that's going to play out. We look at the Empire State number this morning, certainly a very, very constructive number. We've gotten through employment, which we know, employment is lagging, but the numbers in front of us right now are still relatively strong. You look at the inflation numbers, the Fed is still saying inflation is still too high. So coming down, which is constructive. There are global dynamics, we feel, and we wrote about this in our white paper, that are certainly in play right now. Interest rates matter, but so does the fiscal side of the equation. So do global resources. What do you have? What do I need? And how does it flow? And that's going to continue to play out. We think over time, and over time meaning not next week or the week after that, we will need to do more in the United States, here in the homeland, in terms of what we produce for our people and why. And that's likely to be more on the inflationary side than not. It's likely to be something different than I think we've been used to over the next 10, 15 years. Short term here, this week, you look at the market, 2-year yields are certainly repricing. We've had we've had a rate cutting cycle in the course of March, dramatic. I mean, the price action in 2-year yields, certainly concerning. It should be concerning for the Fed at this stage of the cycle in terms of signaling that they are getting closer to the end game and likely a pause to wait and see how things evolve. But to move from north of 5% into 350 within that time frame is extremely concerning. So we're trying to find our way here. We're trying to figure out what makes sense. We still like to use any backup in yield here in terms of prudent location. We still like to use that as an opportunistic way to reposition, to get long some duration. If you look at the 2-year, certainly the focal point right now in terms of whipsaw price action implications for the curve, in and around 415 to 420. That's been a good level, but we sent out a chart this morning. You have to be open-minded. There's a huge gap that we have in March down north of 5% into 350. In 2006 to 2008, when Chair Greenspan went north of 5% and the 2-year peaked a little bit north of the terminal rate, it took a year and a half to get down to 350. We did that in 2 weeks. So be careful out there. It is still a very treacherous environment, but like we said, any strength in the data here short term, any backup in yields with good location, we favor going the other way.